How are y'all today? My name's Scott. I've been an infill developer and real estate broker residential for about 20 years now. So when I first started, lots down in Bolden cost 85 grand, and now they're 585 for comparison. I started building before the McMansion ordinance was in effect, and now here we are today with an affordability problem and a transportation problem and everything else in between because the city has grown so much. And that's putting a lot of pressure on a lot of things, and that's what Code Next is designed to try and alleviate. I've been volunteering for Evolve Austin, which is a broad coalition of all the business groups many of you are probably members of: RECA, ABOR, the HBA, the Chamber, the Downtown Austin Alliance, and then 32 other nonprofits that really run the gamut. And that's really why what's going on is unusual and why I'm so supportive of it. Anybody who's involved in affordable housing, Habitat for Humanity, Austin Housing Coalition, Bike Austin, transportation, tech, really across the board, there's really a broad-based concern that, hey, our city's really starting to move away from the Imagine Austin plan. And the Imagine Austin plan, you might have heard that thrown around here and there, but the Imagine Austin plan was adopted by the city as the goal and the roadmap to how to get from today to where we want to go. And those kind of comprehensive plans are required by state law, and Imagine Austin is ours, and it focuses primarily on a compact and connected city and the benefits that we all get from living in a compact and connected city. So that's the lens with which Evolve Austin looks at the code and says, okay, how can we get there? And Code Next is just one of the many ways to get there, but it's an important one. It's one that relates to all of us in terms of our businesses. So that's what I'll focus on today is really just give you a brief overview of how the process is working so far, and then touch on the residential side of the code, which is what I'm good at apparently, and then turn it over to Ron, who's much more of an expert on the commercial side. So between the two of us, you should get a pretty good overview, and I'm going to leave a little time for questions, and Ron will as well, because what we're trying to do today is take something that is inherently very complicated and try and make it a little overly simplified. So I'm sure we're going to miss something, and if not, you're welcome to reach out to us for answers afterward. So please keep that in mind. So the process started several years ago, but only recently with the release of the version 1 of Code Next, it really came to sort of the public forefront. Version 2 is the version we're on right now, and version 3 is what's coming next. So everything I'm talking about today and that Ron's talking about today is in version 2, so we're going to talk about some of the problems with version 2, and then where we hope to go in version 3. So version 1 was sort of roundly sort of panned as being inadequate. For a variety of reasons. Some of it was hard to understand. The city didn't do a good job of rolling it out, frankly, and there were a lot of inconsistencies and so on. So version 2 came out, and our initial take on it was that it was 2 steps forward, 2 steps back. But in fact, when we really started to look at it, and Ron and I both were on the AIA charrette, where we got groups together, the architects got groups together to analyze specific tracks, under the old code, and then compare it to the new code to see what the differences were. And that we did the same thing on version 1 and on version 2. And I was in the R3C zoning group most recently, which is residential scale zoning, 3 units. And what they found was that effectively it's a down zoning. So for a variety of reasons, some non-zoning and some specifically zoning code related, it has reduced unit yield. So unit 2 was a step in the wrong direction in many ways. And so we are expecting and really pushing very hard for version 3 to swing the other way, because it's going to have to, in order for us to generate the units that the city needs at prices that they have to be at. You're going to need to generate more units just across the board. So for the residential zonings, you've got the code, and then you've got the map, and then you have the model. And the reason this structure is important is they all are tied together. So the code says, okay, using these zonings, you can generate X number of units per acre based on the zoning you've got, kind of what we're all familiar with, right? Well, you could have the most perfect zoning in the world, but if it's not on the map, it's not going to change anything. So the map is tied to the code. So version 1, they had a map that was very hard to explain and almost haphazard, and it was completely unpredictable. And that's part of the problem that they had, is people couldn't understand how the zonings worked or how they went on the ground. Version 2, it got a little better, but not very much better. So the maps were still hard to understand, but one important change they made in version 2 was to include corridors. Imagine Austin plan identified corridors for growth, and those corridors are included on the map in version 2, and that was a positive change. It's one of the 2 big positive changes that came out of version 2. So there's a lot more area that's going to get a lot more of attention in terms of zoning in order to encourage transit and everything else that comes along with units that are built in the right place. But those units aren't just sort of spread around the city. They're really directed where they should be. And that's something that I think everybody kind of agrees on. Both sides tend to agree on, hey, we need some density in the corridors. So we got more corridors. That's why if you'll see unit counts thrown out, oh, version 1 generated this many units and version 2 is going to generate that many. The lion's share of those new units in version 2 comes from the fact that they dramatically expanded the map in terms of what was going to get rezoned. The other big change, which Ron will touch on here in a minute, is that commercial zonings went from only commercial to mixed use. So every commercial zone in version 2 now can have a residential component, which is not the case under the current zoning, and that adds a huge chunk of potential units. I think the most recent model that came out this week was about 53,000 more units out of VMU alone. Those aren't all the units we need, but it's a good chunk, and more importantly, it's a real big change, and a change in the right direction. It allows people to live near where they work, and allows commercial and residential to interact a little better, and that's better for everybody. So the residential zonings are still in there, and they were renamed in version 2, R1, R2, R3, and R4. And you might have heard these here and there thrown out. The number corresponds to the unit count that is the max under that zoning. So R1 is 1 unit per lot. R2 is what we have today as SF3, 2 units per lot, and then R3 is a house or a duplex, plus an ADU in the back, accessory dwelling in the back, for a total of 3. It's very much similar in form to what we have today under McMansion. So you know, it's not a different type of housing. It's just the same. You can just add an ADU to anything you want behind the house or duplex up front. And then R4 is designed to accommodate more types of housing, missing middle housing as we call it. Missing middle, you'll hear that a lot, is anything in between single family, 1 house on 1 lot, and the vertical corridors that I just mentioned, VMU, you know, the high density stuff you see driving down Congress or Lamar. So the thing that is missing from our current zoning process, and certainly the zonings, is missing middle. You know, nobody does 4plexes anymore because you got to get a site plan for one thing, and that's $20,000 to $50,000. So nobody's going to go through an upzoning and a site planning process to build a 4plex. You know, you're just going to stick with the 2 units you can do without upzoning, and you re-subdivide and stick with your SF3 and move on. So because there are so many built-in obstacles to building anything but single-family homes or duplexes or really high-density stuff, our patterns look like this. It's an L. And that's wrong. And it also triggers compatibility because you've got a single-family home right up against some real tall zoning. So what we are big proponents of at Evolve Austin is a stair step. There needs to be a step down there that allows for some missing middle zoning and takes some of the pressure off of the corridor to generate those units, and also take some of that compatibility limit off the corridor, because compatibility limits the height of adjacent properties when you have an incongruity. So you have a single-family home next to a big, tall office building. Those two do not go together well, and for obvious reasons. So there's a code that tamps that down. The reason that's important is because our corridors that I mentioned are shallow lots. 125 to 200 feet deep is the average. So once you get to that level, the compatibility setback, this sort of stair step, essentially covers most of the corridor land that we would like to build VMU on and really increase our transportation options and everything else along with it. So there's a lot of limitations in the current code. In terms of the residential scale zonings, and I gave you this handout not to really review today, but just to show you how complicated things got. So it's supposed to get better, it's supposed to get less complicated, and we're supposed to make it easier in Code Next to build units. But as you can see from some of this, that's not the case. So R3C allows 3 units. You've got a duplex or a house up front plus an ADU in the back. But they've layered on some complexity here that you really can't tell if you read the zoning code, but at the AIA charrette we modeled out, and a lot of things that are not good start to happen in terms of generating units. First and foremost, there's a lot of parking restrictions that kick in. You know, your garage can't be more than a third of your front facade, which is the net result of all these parking restrictions. You got to park behind the house now. So if you build a duplex and then you build an ADU, you got 3 units you got to park, but the parking won't let you park in the front yards anymore as one of your required spaces. So you got to move that required space either inside the structure or around the back. So on a 50-foot lot, which is typical in the city of Austin, 50 by 125 is about the average size urban lot. You end up with parking that's forced around the rear and all the impervious cover that goes with that. More importantly, you can't build new construction more than 80 feet away from the front lot line. And I really want to reiterate that. That is a major shift in the way in which we build houses. You might have heard of the McMansion tent. You've got to build a house right now and inside an imaginary tent. But that tent extends all the way down your lot. You can build wherever you need to get around trees and so on. But under the version 2 of the code, you can't do that. You are stuck at 80 feet with 2 stories. And after that, it has to drop down to 1 story. And that is what we started calling a privacy gradient. The only reason for that is to protect the privacy of the other homes that are in the backyard, because it really does cost units. So the problem with that in and of itself is that it doesn't matter how deep your lot is. You know, your lot could be 200 feet deep, but you can only build 2 stories in the first 80 feet. And then you compound that by applying the same rule, not just to the typical city lot here, but also to the R4 zoning, so fourplexes and so on. But then they even skipped it up into the multifamily zoning. So the same 80-foot setback applies to RM1B, which is one of the lower density multifamily zonings. So you can imagine taking a nice acre that's somewhere in the middle of town. There's still a few of those left here and there, and we'd all like to find one. And I've done a few of those myself. But under the code, that acre is probably going to be zoned RM1B. And if it is, you can't build 2 stories past 80 feet, even on a multifamily zoning. So part of the effort that Evolve has been putting into really analyzing the code is to really break these things down so we understand what happens. And we keep finding over and over again this added complexity and really increased regulatory burden that just makes it harder to build houses, not easier. So even though technically you can build 3 units under R3C, and that sounds like an upzoning, once you apply all the parameters, it's really not so much, you know. And then when you take those same parameters and apply them to zonings that are supposed to build missing middle housing, that's when things get worse. And so that's what we've been doing a lot of. I've left some position papers here up front that you guys are welcome to take with you on things like accessory dwelling units. What are good policies on accessory dwelling units? What are some of the feedback we are providing on administrative changes to the code? And also the affordability section. Obviously, there's an affordability crisis in terms of housing here, and how do we meet that? And the code tries to encourage density bonuses and things like that, but it hasn't been very effective. So we really want that to be effective. You know, really, there's no reason why our code isn't the model that other cities can use in terms of affordable housing. So that's a brief overview, and I apologize if I was going kind of quickly there. That's a brief overview of where we're at. If y'all have specific questions about, zonings or Code Next or the process, about the only other thing that I think I didn't throw out there is timeline. Everybody wants to know what's happening when. So version 3 of the code was supposed to come out December, end of November, early December. Yesterday, the city released a memo that said, no, we're not going to do that. We're going to push it back. And that's to February 12th. So version 3 will come out February 12th. Planning Commission has to take up whatever the most recent version is, run it through their public feedback process, and make a recommendation to council. So that would happen end of February, early March. And then council has to take a vote on it, and the goal for that was set very early on in the process is April 18th. And that's a goal that we are very dedicated to hit for a variety of reasons. One is the process has gone on for an exceedingly long time already. So I think everybody, including staff, is ready for it to be over with. We feel like we've had a chance to really analyze the zonings and make strong recommendations as to how to improve it. So again, we expect version 3 to really significantly improve in terms of these core metrics and goals that Imagine Austin has. All right, so other than that, if anybody has any questions, I'll be glad to give them a shot.
Probably a dumb question, but what's an
accessory dwelling unit? That's a great question. So accessory dwelling unit is a garage apartment. It's a detached dwelling. It can share utilities or it can have separate utilities. It can only be up to 1,100 square feet under the current code, and that same size limitation has passed on, and that's something we feel really strongly about. 1,100 square feet is enough to get a family in there. You can get a 2-2. That's a good functional plan. A lot of us grew up in smaller houses, and in fact, in many cases, large families grew up in little 3-1s that are all these starter homes all over the middle of town. So we need to make sure there's that kind of housing available, and that is something that I think is good about the code, is it does keep the ADUs where they need to be, which is all over Central Austin. It's a good question.
You said 1,100 square feet for an ADU?
Correct. Correct. That's the maximum.
Is there a garage underneath that?
There can be.
There's 2 additional stacks?
You get 2 stories, unless you have new construction in front. If you have new construction in front, your ADU has to be 1 story, and it can't go over the garage. And again, we pointed out that that's almost a non-starter. But regardless, the ADU size is limited by the size of the lot. So it's 15% of the lot area. The FAR is 15%, and up to a maximum of 1,100 square feet. And of that, you can have 550 on a second floor. So about half on the second floor, half on the first. So you can build them over a garage, but you can't make an 1,100 square foot second story.
No, understood, but the garage itself is 25 to 25.
It can be, yes.
Area, and then you have the build of floor number 1 and floor 2, I guess.
So the garage, you can't do a 3-story because that's another downzoning. All the urban zonings currently are 3 stories. They went down to 2. Which again is a loss. I mean, height is the one thing we have to avoid adding impervious cover, right? You want to go up instead of out. So there was a shrinking in the buildable area on all these R-type lots. So again, a lot of these things we're really complaining pretty loudly about. That's a good question. And the garages don't count towards that total, by the way. So it's only HVAC square feet. And if y'all have ever dealt with the McMansion ordinance in the past directly, garages and carports are a big issue. There's been a whole lot of publicity about, like, is putting a door in my carport non-compliant, and how does that work? So they did do one thing right, and that is take that out of consideration. So garages are no longer counted towards your total FAR.
All right. Question here.
Yes.
So the ADUs, if you have an existing structure, you mentioned the constraints relative to new construction.
Yes.
But if you have an existing structure and you're adding an ADU, you can still go.
You can go to 2 stories. That's right. In fact, the 80-foot setback is called a preservation incentive because if you have an existing home that goes beyond that, or you want to add on to an existing home and go beyond that, it does not trigger the restriction, and so you can keep that in there.
The ADU doesn't trigger.
And the ADU doesn't trigger it either, right? And so the reason they did that is not necessarily as a preservation incentive; it's to keep existing homes from being non-conforming, because the new codes were more restrictive. If you didn't include something like that as an exemption, you'd have thousands of homes all over Austin that go beyond that in some way, shape, or form, and it would trigger an avalanche of Board of Adjustment hearings and everything else. It's still a concern in the code, by the way, but it's not as bad. Exactly. It's really a concern is to make sure we're not, making a whole lot of existing housing non-conforming while we're changing the zoning around. It's a good question.
Yes. I wanted to know how expensive would it be to go underground? Like, to add like a level underground versus to have it. And still in my mind, I'm getting a 2-story concept here, but
currently, if you do what the city defines as a true basement, which I'm going to call underground, then that does not count towards your FAR limit. And similarly, the attics don't. You have an attic exemption that don't count towards your FAR. That they don't even call a 3rd story, even though that's what it is when you go up to the 3rd floor to your attic. So there are ways that you can work around that, but we rarely see underground just because of the cost and topography quite often. Yes.
So with all the ambiguity, version 1, version 2 has kind of seen a slowdown in development, or developers just kind of like, hey, let's just jam this through before, it's better to operate with what we know versus what come out, and what are you kind of seeing?
It hasn't. The schedule hasn't been well defined enough yet. In fact, I would say that schedule happened yesterday. That the February schedule is probably going to be a pretty hard schedule. But up until yesterday, it was still kind of up in the air. So nobody had really jumped in. But I will say this: when the first version came out, we all were sitting around looking at it. We went to the AIA charrette. We all concluded that it would create a run on permitting and site planning and so on. Not because the new code was so much better, right? Which is kind of the intent, right? But because the old code was predictable and you knew what you were getting into. So it was the wrong reason entirely. And I would say version 2 perpetuated that. But again, we are expecting version 3 to really, kind of pull itself back out of the mud and up to where it should be. One thing about site planning that's important that I want to mention, one of the core things, and as I mentioned when I started this, from 3 units on up, you have to get a site plan under the current zoning. So once you add that ADU to a duplex, that's 3 units, and that would trigger a site plan requirement under the current code, and that is a year's worth of time and $15,000, $20,000 at a minimum. So part of the code is to eliminate site plan requirements from 9 units or less. The city is trying to do that. The departments have all made a lot of asks. Ron will talk about that. In terms of the non-zoning sections of the code, they are just as bad or worse as the zoning sections. And I want to be real clear about that. You think things are bad now, they're going to get worse under Code Next, and it's because we have to pay attention to the non-zoning sections of the code. All the departments are increasing their asks as a part of the process. So site planning, they've gotten it to 6 units, but now they're getting some pushback from some other departments about, Austin Water in particular, about trying to fit, all those taps into their tight spaces, and they can't get their machine in there, so to speak. And we find that to be kind of a poor excuse not to have, adequate housing citywide, just because the water guys can't figure out a way to dig a hole. So we'll keep pushing on that. Yes.
Could you just kind of bullet point for us a few things that this council has done to make Austin more affordable?
Recently, Delia Garza pulled the DSD budget from the master city budget, specifically over affordability concerns, based on the fact that I think she tried to add an ADU and realized it was so expensive just to add an ADU to her existing house. It cost $25,000 just to get a water tap installed for that ADU, for starters. So recently we've had a lot more attention paid to why is it so expensive, and I think part of that is our new 10-1 system kind of changed the politics a little bit. So we now have a group of advocates that are very strongly in favor of affordable housing, and so it's getting a lot more attention. And in fact, the HBA and RECA and so on, we've all been meeting with development services specifically to help them improve, and that's something that also has not happened, at least in my experience.
Yeah, how much, I read something that said that there was a concern about the number of maybe one-bedroom ADUs that would be built. Is there going to be regulation on density of one-bedroom?
Bedroom counts currently are not regulated, and the parking requirements have changed. They have improved, so it's 1 space per unit under Code Next, whereas currently it's 2 spaces for a 3-bedroom house or a 2-bedroom house and so on. And we are very strong proponents of reducing the minimum parking requirements. Let the market decide what your parking is going to be, and that applies to large-scale buildings as well as single-family homes. But in terms of bedroom counts, the concern that we have is family-friendly. If you generate, thousands of one-bedroom units, that selects for singles, people who don't have families, essentially, And that's part of the problem with the current system is we aren't building enough missing middle housing that is family-friendly, and that's a real problem. So. That's certainly come up in discussions, and we want to make sure that there is adequate scope and flexibility, particularly in zonings like R4, missing middle zonings that let you get multi-units instead of 3 teeny tiny units. That's not really serving the city's needs as well as it could. All right. Thank you.
Thank you. Appreciate it.
Thank you.
My name is Ron Thrower. I have a land planning company. It's called Thrower Design, and we do zoning, subdivisions, and site plans for properties anywhere from small single family all the way up to 350-acre developments. But I also have to point out right quick that my childhood home is only a half mile from here that I still own, and then Little League Baseball, where we played baseball, was just right next to this building on the other side, and that's where I learned to play baseball. So there's been a lot of change in my lifetime, for sure. So Code Next, it's coming, or so we thought. And as Scott mentioned, we got an announcement yesterday of another delay to this process, and you will find very few consultants that are like-minded like me that actually want a code to be simpler, kinder, gentler in every way, shape, and form, and cheaper to get done in the end. And so. That's what Code Next was supposed to start out as. It's supposed to be simplifying the process. It's supposed to be able to be navigated by anybody. They were supposed to be able to pick up the code, read it, and understand what you can and can't do. And it's supposed to be less expensive and more affordable for the end users. And of course, we're not getting that. Version 2 is still a very complex code, and we're still working through it. It's 1,388 pages long. It's got 58 different zones and 146 separate uses. And inside that is 733 instances of conditional use permits and minor use permits, which is a heavily negotiated site plan that will go ultimately through a public hearing for an approval. And so, as Scott pointed out, Scott lives in the residential side of things, and he does a great job with it. Scott's actually also a client of mine, too, by the way. And you would think that Scott and I would have coordinated this meeting a little bit better, but we didn't. Scott and I constantly are texting anywhere from 6 in the morning till 10 at night, but we didn't even talk about this meeting until 2 hours ago. So anyway, there's major zones. You've got the residential house scale zone, the multifamily zones, and then you got the mixed use zones, and then you got the Main Street zones. And I'm going to concentrate on the Main Street zone today, and specifically the MS3A zone, because every one of these has a number and a letter nomenclature that goes with it, which adds to how many zones there actually is in the entire code. going through just the zoning section of the MS3A, the first page shows the building placement, and it gets into the site articulations, and that's how the building is going to lay out on the ground. Some of the articulations are very big. In other words, one of the articulations is 24 feet by 24 feet and has to be every 60 feet on the side of a building. And that takes away from yield, and it adds substantial amount of cost to every project. For multifamily projects, there's a requirement of courtyards along the side of a building, which is a little bit unusual. The next page, you get into the height, and that gets into more of the vertical articulations. Right now, the majority of the zones in Austin have a 60-foot height limit. This particular zone has a 75-foot height limit, and allowing you to go up another 10 feet if you put in affordable housing. And then also on the rear side, there's going to be compatibility of setbacks or stepbacks in the building as it lies up against the residential house scale zones. And then the next page gets into the encroachments about what you can and can't do inside of the setbacks, and it gets into the frontages about how much of your building has to be at the setback line along the street. And that's important from an urbanist perspective because we want the buildings pushed up towards the street to try and create a walkable environment along the street edge. And then you get into the parking about where can the parking go on a piece of property, and that's even a complex process to get to. Then on the fourth page, you get into the impervious coverage. In this particular zone, 95% impervious coverage is what is allowed, and it's impossible to achieve. You get into open space requirements, which is 5% of the gross site area of the property, signage regulations, and then you get into this additional requirements, and that's where I'm going to concentrate a little bit on. Because you get into all these non-zoning requirements that, like Scott had mentioned, you get into buffers and landscape requirements and green stormwater infrastructure and new drainage requirements and transportation requirements. And so if you look at the buffers, there is now going to be a requirement that if you have an apartment project next door and you're putting in an apartment project, they want a landscape buffer in between. So that takes away yield, that takes away density for a property, and it adds cost. And there's even different variations of types of buffers that have to go in. The landscaping requirements. The landscape requirements have increased significantly. The parking lot islands, instances has increased. The sizes have increased. The parking lot medians have increased in between every parking module. And they're also going to be requiring a foundation buffer. So from your street edge, you have to put in a landscape buffer. And again, all these grabs of land take away from density and yield on developments. And then drainage. One sentence in the drainage section of the code is causing a lot of concern with a lot of people. And that one sentence basically says that every project is going to have a large detention pond on the property or is going to be paying into a fund for the city infrastructure to get improved. And this is going to have a significant impact on yield if you're putting a large pond on your property, or it's going to cost extra money for the developer, which then gets down into the end user. Transportation. Right now, the transportation code says that you don't trigger a traffic impact analysis until you reach a point of 2,000 vehicle trips. They're lowering that to 1,000 vehicle trips. So the trigger is going to be at a much lower scale, but they're going to do this as an effort to try and get you out of your car with other measures, and that's called the demand management side of things. And that's, again, a much more complicated code that's coming into play here. In the end, we have a 1,388-page code today, but there's more because there's going to be all these criteria manuals that are going to go along with it. I'm estimating there's probably going to be 5,000 pages of criteria manuals that haven't even been written yet that are going to have to dovetail into what the code says. So we've got, I think, a much more complicated code coming our direction, a more expensive code, and the end users are going to pay in this. And I'll also say that we looked at a built project today on South Lamar, and it's down there where Panther Trail is by the Ann Richards School. And that site is built today with 307 apartment units and about 3,000 square feet of commercial. And we looked at MS3A zoning on that property because that's how it's designated. In the end, because of all of these other asks, landscaping, transportation, detention, buffers, all that, In the end, we can only get to 215 units on that same piece of property. And that's after we added a floor to the building. It's built at 5 stories. We even made it 6, and we could still only get to 2/3 of where it's built today. And so we are working hard. I'm probably spending 20, 25 hours a week working on Code Next. I know Scott is doing the same, and we have probably a dozen of us that are deeply entrenched and committed to try and make the code better in the end. And I'm hopeful that version 3 is going to be a better document. If it's not, I'm just going to quit and retire and go to Canada or something. But that, or I'm going to get rich. You know, that's the alternatives, because the prices of every site plan are going to be 2 and 3 times what a site plan is today. And that's not what I want. I want more good projects on the ground, and I want it to get done faster and cheaper. And I would rather permit 50 projects a year rather than 20. So with that, I'm available if you have any questions. I left my business card up here too if y'all want to take one. Yes, sir.
Take a shot at the question. I'm not sure exactly how to formulate the question. There's a lot of things that you said all seem to point towards the changes in Code Next are going to drastically increase the cost per unit for commercial housing, which seems counter to what City Council says they want. But you also said you might just quit because it's just getting so nasty that, you know, I just don't even want to mess with it anymore. So extrapolating that forward as an investor in CCG, what I'm interested in is Code Next going to create a forced cooling of the Austin market? Is it going to force people to think, you know, I'd rather be building units in Waco. I think I'll go down to San Antonio. I think I'm going to pull up stakes and go do this elsewhere.
I don't know if it's going to be a forced cooling. I think there might be some cooling. You know, right now, time will tell on this, but when they adopt Code Next, they're talking about having a grace period where a 6-month time frame where somebody could develop under the old code or under the new code. And I think personally during that time we're going to find a lot of people developing under the old code. So I think that for a short period of time we're going to have a lot of projects that are still going to get permitted, and I think people are still going to want to move here. But I also do think that, yes, we're going to see outlying development occurring, sprawl, which is, you know, not what we urbanists want to happen. And I think that you're going to see some of that go into the outlying areas of Austin and even out to the outlying cities.
So then what your answer was, the Code Next net seems to have 2 effects. One is to raise the cost of what would have been more affordable housing, and number 2 is force all new construction farther out, put more load on the transportation.
Right. Yeah, it seems counterintuitive completely. I agree.
Good job.
I'm sorry, I sit here and listen to that, and this sounds like a roadmap of the downward spiral of a litany across this country of urban areas that declined into nothing more than shells because nobody wants to live there, nobody can afford to live there, and nobody's going to come live there. You know.
That may be, you know, and I think that Austin is a little bit different type of market. I think there's a lot of people that still want to come and move here.
I'm drawing the analogy between true downtown urban areas
right.
and what's happening here in Austin, because we're not that big. You know.
I agree.
Yes. Are there any other cities that have been through this process that you have history on? You lived their experience.
Yes.
What's their status?
Well, first of all, let me say that Austin has spent $8.5 million so far with the consultants getting this code to this point today. City of Cedar Park rewrote their zoning code, and in fact it got adopted last week. And they spent $200,000 writing their zoning code. So there are better ways to do it. I do think that the consultant that Austin has hired is actually a very good consultant. If you were just to put that consultant in a room and leave them alone and let them do planning, I think that Austin could have a great code. But then you got to dovetail into that the policies and the politics and desires of council and all these other forces, and that's what has got us to where we are. It could be much better. Yes, sir.
What, in your opinion, is the main political or policy driver of that complication in the team?
Well, I'm glad you said it because that's the first thing that popped in my mind. I wanted to say it, but I do think a lot of it is that, it's just change in general. Austin doesn't seem to like change. They don't accept change, even at the council level. There's constant pushback on change on anything. Thank y'all. I appreciate it. Again, if y'all have any questions, feel free to email us.
Okay, I think everybody, really enjoyed Ron and Scott. I saw, more interaction, I think, from the group to them than I've seen in a long time. You said that, not me. Dr. Perkins says you're getting smarter, so I didn't say it. But I think, it's really important, no matter what side of the aisle you're on, or if there is even an aisle but this is really really going to change our city for years and years to come. I see it as far as in the construction, but also as a resident and also as a lender here. I think that as Ron said, we'll still have people moving to Austin. You still have job growth here. We still have a very, very low inventory across the board. On everything, really, all classes of real estate. So, and then there'll be people that, will be innovators coming out of this too when the Code Next becomes, final. So I really appreciate them coming, taking time out of their schedule. I think everybody enjoyed it, and just give them a round of applause. Thank you. So, state of the funds. 2017 is kind of where we're at right now after the third quarter, and kind of give an overview of the two funds. I'll give an overview of two funds, basically the legal structure of them, management company, and then we'll dive into some charts and graphs and things of that nature. So some of this may be rehashed for you, but I'll just hit the high points. So Capital Group, which is a management company, we were established in 2008 as Pride of Austin Capital Partners, as many of you know. We're an LLC in Texas. We manage 2 Reg D securities. There's no performance bonus. Managing members myself. We have an advisory board, and the members are investors in both funds. There originally were 5 members of this management company. Without rehashing the story, we're down to 4, and those are the 4 still. So 4 out of the original 5 are still in it today, almost 10 years later. Quick snapshot of kind of where we're at with our 2 funds. Of course, we're in Austin, North Carolina. As many of you know, we're in the Raleigh-Durham, that research triangle, which is a very strong market. Also in Charlotte area. We've been in those 2 markets now almost 3 years. We have one loan out in Roseville, California, by the Galleria in Sacramento. It's a commercial place out there. The Falls Event Center is the bar, and we're looking at being paid off from them in about the next 4 to 6 months. So, and we won't be going back to California anytime soon. Not to say this isn't a good bar. We just, we did a loan here in Austin and Cedar Park with them. Thus, this is where we came away with this one as well.
Not actively.
No, not actively. I'm not sending them to California or North Dakota. Not Wyoming either. Alternative investing. Why is an investor is alternative investing? You get passive income. Investors not responsible for due diligence. Jim, I'll use Jim as an example. Jim, had commercial real estate, started selling it off, got tired of being the landlord, so to speak. I think he kept some of his bread and butter, but then started investing in with us and other people, as I assume, as well. And, he gets mailbox money. He doesn't have to do all the due diligence. He doesn't have to service the loan. He doesn't have to, track down his tenants. all that stuff. So you get mailbox money, direct deposit. You know, we've been doing, I think we've been doing a pretty good job on our ACH transactions and rolling that out. So money in you wake up the next morning or 2 days later, and there's your money. After we announce, obviously. Be the bank. You know, you are the bank. We are the bank. We're a private bank, essentially. Tangible asset. You know, where you invest in the stock market or mutual funds. You have a piece of paper, even if you even have a piece of paper. This tangible asset, you have something tangible. You know, you can go, we have something to take back if we have to. Private lending. Why is private lending, you know, around? Ellen could probably come up and talk a little bit about this. You know, conventional banks are not lending to developers, to you know, fix and flippers. They're not lending. They're still not lending at the rate they were lending prior to the mortgage crash in 2008. So there's still a need for private lending out there, and it's growing. It's asset-based lending versus credit-based lending. So we're truly looking at the asset. We are looking at the bar, and then, you know, their credit score does have a little bit of a play in it. Somebody has a 400 credit score, we're not going to be their lender. But we're really about the asset. We're about the contractor as well, the exit strategy. So it's all based upon the asset. Flexibility. So as a private lender, we're flexible. We don't have a bank, a loan committee that sits around a table in suits and ties that really don't understand development. We're flexible. We're local. I think that really plays a lot. Faster underwriting. It's up to the bar to get us the information, but once we get it, we can move at a faster rate than a traditional bank. Underwriting. So many of you may know, may not know, that I teach a class out at the private lending, and I teach on underwriting and servicing. So underwriting, you know, I say this is my first line always, guard our lending parameters. So we set our lending parameters. Our lending parameters are defined in our PPM. We set that bar. We don't raise and lower that bar depending upon a loan request that comes in. Either a means of first filter. Either it passes that, gets over the bar. If it doesn't, we let the potential bar know why it did it. So they can maybe adjust on their end. Maybe it's more capital. Maybe it's this. Maybe it's that. But we guard our lending parameters. And I think that's what's made us successful. If I point back at a couple of things, I would say that is very successful because it's simple, stupid. We set our bar, and that's where it is. And people know that. They respect that. Underwriting, we're looking at the asset. We're looking at the bar, financial stability, exit strategy, and contractors. All four of these are, right across the board on the same plane. Now, I wouldn't say one is greater than the other. Contractor is, equally as important as an exit strategy, as it is the bar's financial ability to service the loan. And of course, the asset, and we start there. If there's anything, asset would be probably a little higher. Consistency. Going back to guard our lending parameters, we're consistent in our structure. We're not changing it up. We're not reinventing the wheel. We never put out money just to make a loan. I would rather give money back to investors if there comes a time where we have too much capital than make a loan, make a bad loan, which would, because we're not guarding our lending parameters. Consider investors first. Like I said, management company, all the members in there are investors. So, we're considering investors first. We're not going to make a loan just to make a loan. Servicing. So we service our loans in-house, and I think that really is another area where we've been able to be successful because we don't have a third-party servicer in Iowa or California. We do our own inspections. We require down dates on the title when it's a construction loan. As the loan amount gets higher, we have the bar give us a down date, making sure there's no new liens popping up. If there's a blimp, say we're scared of a bubble maybe coming in a certain market, we can always ask for a value check. Having that appraiser go in and give us an up-to-date value. Communication, I think, is the biggest thing. Is we're always in communication with our borrowers, almost on a weekly basis. Loan exit. I mean, we can make a loan, but it's equally as important to get the money back, so we can make more loans, right? So, loan exit. You got payoff, which is what we want. Extension. We generate some more income for the funds. We push that maturity date out a little bit. Only if they're in good standing, or only if there's no liens. The borrower's in good standing. They're not in default. A workout scenario. Now you're getting into where they may not be they may be, on the verge of being in default. There may be, where they haven't paid their interest. We may have to cut some interest back to get our payout. So we're foreclosure. Obviously, we want to protect our asset. That's our collateral. So, if we can't exit the loan, then we're going to foreclose. Then liquidate. Always liquidate is our strategy if we foreclose. The opportunity fund. Now we're getting into the different funds. So opportunity fund, the legal, it's a Reg D securities filed in all 50 states, organized as an LLC here in Texas. Investors are members, 100% owned by investors. It was established a little over 3 years ago. It runs through 2034, 10-year extension up to 2044, and majority of the members may extend beyond that. It's accredited investors only, $50,000 minimum. It's a 2-year lockup period, semi-annual distributions. So it's June 30th and December 31st, and I think that's a repeat. I just want to make sure it's owned by investors. So a couple differences here that I highlighted here with the Opportunity Fund versus the High Yield Fund. Second liens are permitted, provided the first lien is held by the High Yield Fund. So we're not going to do a second lien if Wells Fargo is the first lien. We lose control of that. Then if something happens, if the first lien holder wants to foreclose, then to protect our lien, we would have to buy out the first lien. So that puts us in a position we don't want to be in. So we were only going to do a second lien if the high yield fund is in first lien. That way we are in control. It's up to a 5-year term with extensions possible of first liens held by the Opportunity Fund. So this one it can go up to 5 years. We haven't done a 5-year. We've only done a max of 3 years, if I'm not mistaken. But it does allow up to 5 years, whereas the high yield fund is more short-term, a year to 18 months. This was as of June 30th, the semi-annual. As you can see, it has more peaks and valleys than you'll see in the high yield fund. The reason that is we allow the interest to accrue. So we're a cash basis accounting. So we only recognize a dollar when we earn that dollar, when we receive that dollar. So that's why you see these peaks and valleys there. So we receive interest if there's an extension. We collect some interest then. We also collect the interest, obviously, if there's a payoff. We also generate income when we originate a loan. And at June 30th, this is with our breakdown, $9.5 million. Moving into the high yield fund. So again, it's a Reg D security filed in all 50 states. It's organized as an LLC here in Texas. Investors are members, and it's 100% owned by the investors. It was established in 2008, so we're coming up at the end of our 9th year. Its filing expires in 2028, and another 10-year extension is allowed by the manager. And of course, the majority of the members can extend beyond that. Same parameters are same as the Opportunity Fund. So here are the terms on the high yield fund. So 9 to 18 months is the terms. Up to 2, 3, or 6 month extensions possible. We have gone up to 9-month extension in the past, but only one of those. So it's kind of max of 70% LTV. That's loan to value after repaired value. So, if we're a construction lender, we're given a value on what's to be built. The appraiser's valuing that at some 6 month in the future, 9 month in the future. That's why it's important we can have value checks, because as this asset is being built, if we're seeing signs in the market where might be starting to question that value that was given, we have the ability to require an updated appraisal. And that way, if our LTV, say the loan was at 70%, and now the loan is at 72%, our loan docs allow us to request that the borrower pay down, or they're in default. Interest range is 11 to 13%, and 3 lender discount points to the fund. Here's a chart over the last 3 years. So you see, pretty much anywhere from 10 and a quarter to almost 12%, over the last 3 years. You'll see in the Januaries that they're a little lower. That's because we have we're cash basis accounting again. So we have our compliance that we have to do each year. We have our accounting, our tax accountant we have to do. So we have all these expenses at the beginning of the year that we do not accrue, and we pay then. So that's why it's a little lower there. Here's the breakdown. I just sent this out, but here it is. So as of September 30th, we're at $68 million assets under management. We got a big slice of the pie on residential construction, which is, across our markets. Non-performing, 0. REO went down. We sold the hotel in Stanton. So I was really excited about that. To be honest, I'm really excited. I didn't lose much sleep over that one, but I was nervous. And we had an operator out of Dallas, Fort Worth, last name Patel, and they had 17, 18 hotels in their portfolio, and they kicked the tires and they bought our hotel and the Candlewood Suites, I believe, that was like half a block or half a mile away. They bought both of those at the same time. So they have one side of the road, one side of I-20 or I-10, whatever it is, I-20, and the other side of I-20. So really excited about that. And of course, we haven't added any non-performing. We haven't added any REOs. So we still have those 2 full-share buildings, which I'll get to. I'll give you an update on that in a minute. Reserve account. So we always have a reserve account. A rainy day fund. We're a little shy of $2 million there. Commercial income producing, about almost $6 million. Commercial construction, a little over $10 million. And as you see, commercial development, 7, and then some cash on hand. So, and this was at June 30th, so we had some cash. We had a little bit of cash on hand. We had some loans pay off. I believe for the third quarter, we had, if I'm not mistaken, we had about $5.5 million in loans originated. We had, not including the hotel, we had about $6.5 million that we. Sorry, I reversed that. We had $6.5 million that we originated, and we had $4.5 million that paid off, not including the hotel.
And the hotel was reflected that income in the last second quarter.
Yes, no, it was the third quarter. It was the third quarter, but there wasn't a loan payoff or a loan origination, so it was an REO. So.
Yeah. What is the commercial income producing?
Commercial income producing, that would be, that is the Falls Event Center. That's in Roseville, California. And what else is there? There's something else. I'm blanking right now. But I can.
Because that's not the income coming off the full shirt.
No, because it's an REO. It's an REO. Right. There's another loan that's you put me on the spotlight, yeah. But no, it's the REO is an REO. It's not double dipped there.
The Roseville thing, that's still under construction.
No, they're operating. They've been operating for about 6-7 months now. Right.
What kind of income returns are we getting off of the income producing?
Well, it's an operating. So we're not really receiving the income. I'm labeling it that it's not a construction loan. It's more of a bridge loan or semi-perm loan. So we're not funding a construction. So it may be a strip center where you have a landlord that's receiving money.
Are they servicing?
We service them.
I mean, are they paying their debt service?
Well, yeah, no, it's interest only.
Okay.
All our loans are interest only.
But they are current.
Yes, we have, because if they weren't current, then we move them up to non-performing. So this was this hotel in Stanton that we talked about. I left it in here just so I could talk about it. But anyway, to let you know we sold it. So anyway, it's gone. No, we didn't make any money. We had some interest that was sitting there that we don't accrue interest, but it was sitting there, and we weren't able to realize that interest. So we got our capital back, and maybe $17,000, I think. So we made a tiny bit, but when closing costs ate quite a bit of that up. So the high yield fund, we have the 2 REO properties down in Fulshire. We just signed a substantial lease. A while back, we had Lowe's was in there. They were doing a hiring center in there. Now HEB has basically taken over their spot and increased it. They're doing a hiring center because they're building a new HEB in Fulshire. So we have multiple tenants in Building 1. We're receiving income on that. So this really needs to be updated. Lowe's hiring center is now an HEB hiring center. I apologize. Let me stop here. I apologize that I had to do my own PowerPoint, and I'm not very good at doing this. Tibet and Ryan Stewart, they had they had a little girl back about 3 weeks ago, so she's out. So now they have a second daughter. I feel sorry for Ryan, but anyway. Just everybody's doing well there, and so that's why I'm having a little. Just be honest with you about my PowerPoint here. So.
You're trying to explain away the typos, right?
Exactly. They're not numbers. There's no typos. So HEB has a hiring center there. Building 2 is if you remember, is the shell. We didn't finish it. The church had it under contract. They could not get the adequate parking that the city required, so they dropped off. So we're still, we still have it. We're still working with planning and zoning to replat, to subdivide. And it's kind of like Austin, not really going much anywhere. It's a small town and politics. It's managed and marketed by Central Management. Trent Vosick is our broker down there.
What kind of income do those?
We receive probably about 4 or 5%. It's triple net leases.
And Building 2 is totally vacant.
Totally vacant. So as a whole, we're getting about 4%, I would say.
In that area, Rob, when Jim was down there, he seemed to indicate there's growth.
There's growth down there.
It looks like value could actually increase.
Yes, there could be. It's been a little slow, I think. With the energy. It's still outside of Houston, and
How far out is it?
Sorry?
How far out is it?
I think it's 40, 50 miles.
About 40.
40, yeah, something like that.
Center of downtown. Center of downtown.
Yeah.
To the west, or?
Yeah.
Yes, due west on
I
I-10.
mean, it's essentially right next to Katy.
Yes, it's right before Katy.
You've heard of it too, then?
You only have to go about a half mile to a mile at the most where you hit a dense population.
Oh yeah, there's dense population now, and then of course Harvey. They had some major flooding down in Fulshire too. Luckily, we had no issues. We had like $4,000 worth of damage to both buildings, so that was good, very good. So yeah, I'm optimistic. Eventually, it's going to come around us because it's down the road, like you said, Jim. The growth. And HEB's building a new center there. It's not like they didn't have one there. Because somebody had. Oops. Yes, sorry.
Because we were set on the poultry there.
Yes.
For all the real estate out there, we do maintain insurance.
Oh yes, definitely, yes. We maintain insurance on anything REO. Of course, and let me just go off of that. Our bars, we require obviously insurance on all the properties. Builder's risk. So as they're adding value, they're going up. Builder's risk is, in case act of Mother Nature, fire, whatever it may be. If it destroys what's going up, that insurance policy's there to put it back in place.
When it becomes owned by us.
Oh yes, right away.
Put on my risk manager hat.
Oh, definitely. Investor portal initiative. Now this was not updated from last lunch and learn. So we've made great strides in this. And Jacob has spearheaded this for us with his company and done a fabulous job. I really appreciate all the hard work he's put in. So we're now at the stage where we at the office, the team, we're just trying to make it break, and we can't make it break. So that's a good sign. We do, I guess, a shakedown, basically. Like a race car, you take it out on the track and you shake it down and see what falls out of it. And nothing's falling out of it. So that's good. So now the goal for us now is to have your fourth quarter, at the beginning of the year, have have this thing live. And we'll be updating you how this is going to roll out and what's your role in as an investor. It's just going to be a very scaled down version of you going to Wells Fargo or whatever and logging in and seeing your statements there. Be hopefully very simple, very easy to navigate. I feel like so. Be looking for this over the next month to 2 months as we roll this out and send out your information, how to log in and all that stuff. And coming up, just accounting reminders coming up. It's already November. If you're an IRA, self-directed, you'll have valuations. I did update this, Dr. Perkins. So 2017, I caught that. See, numbers I could catch. So valuation for 2017. If you have a self-directed IRA with a number of custodians out there, they'll send you a form. Please get it to us so we can take care of it for you and send it back to you and your custodian. And then K1s. As an investor, you receive a K1, and March 15th would get those out to you. So you can have a month to file your taxes.
Is that a hard commit date?
That is a hard commit date. It will be.
This is not a new subject for us.
Sometimes my hands are tied with these. So I know that was fast, but kind of want to get through it because I think we all really enjoyed what Scott and Ron had to say. So I'll open up if anybody has any questions.
I have one.
Yes, sir.
Very simplistic. Should I wish to move some of my funds from the high yield fund over to the other fund? Not a problem doing that.
Not a problem at all.
It's paperwork.
Yes, sir. Well, too.
Got one on each side.
Yeah, exactly. John.
Yeah, well, first off, congratulations. I mean, the interest rates, the returns have been very consistent.
Thank you.
Exactly, at least why I got in the fund. And so, congratulations on that. Job well done.
Thank you.
I'm curious. With the gap now, with the big banks and whatever, are there institutional people coming into doing it, filling this void? Is there competition?
What we're seeing is, and we get calls probably a couple times a week. You'll have these institutions that have little satellites that break off, and they'll contact us and they'll want to buy our loans. And that's not the business. That's not our business model. One is they're not going to take something that is not fully funded. Well, most of ours are not because it's construction. And if they are, there's only a short gap there before we get paid off. So it's really more, you're seeing more, I'm seeing more of that. Ellen, you're in it quite a bit. Do you see any more institutionals out there?
Actually, I don't, and I don't. Banks are actually my best referral sources. All of my business comes from big banks that aren't funding loans for their own customers.
Right.
And so they call people like me because obviously we don't have a requirement of where the depository relationship is.
Right.
So the deposits stay with the bank, but yet we can come in and actually do the construction loans and then convert it to permanent financing if that's necessary, or they pay off in full.
Just some background. Ellen is a broker, probably the only broker I've worked with in the last couple of years, which says a lot about her and her business and her ethics. Really respect her, and she became an investor, I guess, 2 years ago, and so that's why I asked her, because she's at the front end of things and would see more, what's going on. Because I now that you said that, I remember there was a few deals you brought to us that the bank called you up.
Yeah, in fact, that's my only referral source. I don't market, I don't advertise. I barely even carry business cards with me.
That's a nice way of doing things.
Yeah, so I work with the banks, and that way I get a good background information on the customer before I even talk to them.
Because they've done a lot of research
They know
and
them. They have
diligence.
the deposits.
What the biggest struggle I have, Robert, the whole thing is that it seems like with money being so cheap, you're zero or less, and people are willing to pay this amount on, getting a loan. It's just hard to fathom something.
Well, it's either they pay it to get it or they don't get it.
Yeah, banks are not going to loan the money, especially if it's new construction. Banks don't want to touch it, no matter how solid you think the deal is.
For new construction, to build like a Planet Fitness, to do any of that kind of stuff.
No.
Isn't that crazy?
That is crazy when you think about it, but that's why we're in the market.
Yeah, no, I can see that, Robert. It's just it's hard to fathom because that's not the way I was raised. At a bank, you went to an institution, they took care of you, they just took care of you.
Been on their rock.
Frank Dodd is really.
So is that what did it?
Frank Dodd, yes, because it's 2 to 3 times they have to have in deposits versus what they loan out.
It's our friend.
Oh yeah.
I mean, that's in a very oblique way. It's great.
Yeah, and then also I may add that you have not only the banks are lending, so then you get into where you have equity positions. Well, as a borrower, you lose control. If you bring in an equity person, then you're losing control of it. Basically, you're selling off 20%. Yeah, you lose equity. So you've got another person basically in the room making the decisions with you. We're not, we're a lender. We have to have our lender hat on. We're not going to make decisions for you unless you are in default. Then that's when we'll start making decisions for you. But we're going to let you, because we did our underwriting, our background on you. We're going to let you do what you do. You're a builder. You're a developer. So you have control over your project. And so when you look at maybe selling off 20%, look at us, 11 and 3, that's 14. They get control, plus they save 6%. If there's a broker involved, they save 4%, and they have full control over their project. Ray.
Two things. Can you talk to us a little bit about loan demand? Is it still good? And then growth of the funds year over year?
Loan demand is still out there. We've gotten a rash, I would say, in the last month of just I would say, like in better terms, kind of some trash loans, bottom feeders and stuff. But we do have we had a good one that Ellen brought forward to us. I think she's still working on the guy a little bit. Some of them out there paying a little hardball. We've got one that's we just got this week. Down in Kyle Buda area for 54 lots down there. So, we're still seeing activity. I'd say there was a little increase in activity of loan requests, but not the jump, the quality of them, I think it's still about the same rate. Year over year, the last couple of years, we pretty much have been just a slight maybe growth or flatline, as a fund, as total funds together. Just because I think we're at this point now, we're 9-10 years in, and life happens. We've had people that have passed away, and we've had people that have life-changing events. They've pulled out, moved to Saudi Arabia, whatever. I've had people, so all kinds. But then I've also had new investors come in. So I think we've been floating. I think we've had an uptick. Over the last probably 2 years, we've gone up in the high yield fund probably $5-6 million. From like 32 to 38 now. But not like we experienced back in say 12 to 14, where we had a pretty good increase there. But it's comfortable. This is where I think as the managing member, I think the team that is in place, this is really our good comfort level here. You're not going to expect us to jump up to 50 million. That's not. I don't see that as our comfort level. I think we get to 40, and I think we're at our comfort level here. Justin.
So, kind of looking forward. I mean, is it kind of a 5-year plan of looking for some more diversification outside of Austin, or kind of with the code next in limbo, or is it we're doubling down here? What's kind of the strategy, and also throwing in the mix Harvey in Houston. Is there any appetite to get involved in restructuring?
I mean, we're Texas-based, so we're all in on Texas. Obviously, we're North Carolina was just was a right fit. I had a relationship with 2 guys out there. They're principals in a company, and I've known them for 8 years, and they've been a bar now for 3. So I didn't send a mean out there to go knock on doors. We kind of. It was just a right fit. So we've always, Austin, Code Next is a little, it's a little scary. What's going to happen? We don't know what's going to happen, I guess. So we may know a little bit more now. But Austin's growing. I mean, you got people moving here, and you got jobs moving here. So there's a need for it. So, it's going to be some changing here, and if somebody's bringing me something that they're going to be able to permit, need a site plan that's going to be, a year from now, which we wouldn't do this loan anyway. This is just an example. I wouldn't do a loan because you don't know what that's going to be like in a year. What they're bringing me on paper may not be able to be built, right? So unless it's something, single family, a duplex, something that I know can get into permitting, get out of permitting within the next 4 or 5 months, not looking for something down the road like that. Houston, we were in Houston. When did we get out of Houston? We got out, when was the oil market? Into 14? Into 14. So at the end of 14, we were probably 15 loans deep into Houston, and rocking and rolling down there. And then you started the summer of 14, started seeing oil kind of. And I told me and Dan, I said, we're not doing taking any more loan requests for Houston. And the bar that we had, I think we had 1 or 2 bars, but anyway, they worked through. We got paid off. No defaults, nothing. They really worked hard. Matt Solomon and his guys. But we haven't been back. But that was because of the energy, And now you got Harvey. But you see, Amin could probably speak a little more on this. You see, I was talking about some trashy loan requests we got. It's coming out of Houston. You get some, the water rises, snakes start going. So you got to be. I mean, it's true, right? I mean, right, Jim? I mean, it's. So you got, I'd like to get back in there. I'd see oil ticking up a little bit. But you got to really be careful in these rehab markets like that, especially when you had total destruction. So, yes, sir.
I have a question. What's your opinion of the impact of the potential repeal of Dodd-Frank?
I haven't really studied that, to be honest with you. So I don't know. I mean, we are in in an environment where regulations are being cut.
Does that affect the bank's ability or desire to get into this market?
It could. I mean, if their requirement now is 2 or 3 times, so every dollar that they loan, they have to have $3 to back it up. So if that goes down to 1 to 1, I mean, yeah, I would say so. But I think you got to I think interest rates may creep up a little bit. I don't know. I don't know where we're going to go with that, to be honest with you. I can tell you this, that before Dodd-Frank, private lenders existed. And they were at a higher rate. I mean, when we first got in, we were lending them 18%, which is the limit in Texas. Then you had some California money move in, so we had to drop our rates down a little bit. But that was really before even Dodd-Frank really became, what it is today. So I think, we'll have to just kind of adapt, see where our niche is if that happens, and where we go.
Robert, if Dodd-Frank did go away, it could go away. That would certainly give banks more ability to get into our space. But I have a hard time believing that it would give them the desire to want to do the underwriting included.
I agree with you, and also you got to think they're still credit-based lenders.
Yes.
So you have developers that are putting, tying up their credit. So if they have their mortgage and they have this and that, how are they going to qualify for this? They're not. You're not. A conventional bank's not going to do a 54 lot subdivision. It's equity. It may be a little bank loan, but it's minor. It's all equity in tiers, waterfalls, and things like that. So
they don't want this risk space.
No, they don't want this risk because once they get it back, they know they remember what happened when they had to take all this back before. When Amina and I went to the conference this past weekend in Vegas for private lending. What movie did I watch? The Big Short again. Of course I watched it. So, those, water. The guy, I think waters are, anyway.
I can't even remember that far back. How high were the rates on the banks would lend money on construction development back in the day? Or how much higher than normal?
I don't know.
I can't even remember, too. Anybody remember?
We paid 21.
21?
Wow. Even if the executive branch issued an executive order and did away with Dodd-Frank today, you got to remember an institution the size of U.S. banking, when I say institution, I don't mean be laid out here on the corner, right? I'm talking about that industry institution. It takes them 3 to 5 years to react and implement that change. Look how long it took to implement when they put it in effect. They still haven't got it all in place.
You're right. They still haven't rolled out all of Dodd-Frank that they initially set up.
Yeah, this is not something that's going to throw up like a mushroom.
Miss Susan.
Since 2016, 2017, we've only had small incremental increases in the interest rate. What point would you anticipate that interest rate increases, say within the next 5 years, might be affecting your business?
I don't really think it will affect our business. I think, all of this kind of with the Dodd-Frank and if it goes away, I still, when you look back at it, what makes us attractive is we're asset-based lenders. When you boil that down, whether the bank, now it could have an effect on the exit. So if you have, somebody going in and building a subdivision, obviously, interest creeps up on home buyers. That could play a role in that. But when you talk little bitty increments that we've had, I don't think it's really. I haven't seen it affect us really. And even the talk of it's not scaring these markets that we're in. You still see them flying off the shelf. Yes, sir.
Okay, I'll take my shot. Everybody's asking the same question from different angles.
That's fine.
First, let me just say congratulations, obviously, are due, but on the hotel,
yes, sir.
Special congratulations, because that's the model that attracted us here was the safety, because you've got that asset and you just actually pulled it off as a poster child for the fact that asset protection actually exists. So congratulations on that. My question is, everybody's throwing at you, what about this, what about this? Okay, I'm just going to turn it around and say, what do you worry about? What do you watch out there as an indicator that makes you think this way?
Well, you have my table next time. No, what I do worry about is when I look at supply demand. So we got in these markets, you have job growth, you have job unemployment rates. Where are they at? What is the inventory at on homes out there or commercial space? Whatever the classification is. Is there high occupancy in commercial space? Is it low? We're just really looking at supply demand across the board and seeing where we are. And if there's, if we have inventory of 9 months here in Austin, well, I'm not going to go make a loan on a single family house that's good. The exit strategy is going to be to sell it. You got 9 months sitting out there. But here we've got little less than 3, or right at 3 months of inventory. In a steady, an equilibrium type market, it's 6 to 7 months here in Austin. So then you look at unemployment rate. I mean, it's almost scary low. Because when it gets too low, the job force isn't out there to hire adequate employees. So I just go back to my economics at my community college and, supply demand, really, to be honest with you.
And none of those worry you right now?
Not in these markets that we're in, no, because it all shows that low inventory, high demand, low supply, high demand. And I think that's why you continue to see price increases, in Austin. Now they've kind of flattened out a little bit. This last thing I got from Austin Title it was kind of the prices did have flattened, but the inventory is still low. Actually, pendings are up, sold are up year over year. Same when in the markets in North Carolina. So that's where I really study hard at, is those type graphs and charts. Jim?
There's a lot of numbers that get generated at the Austin Home Builders Association. Yep. Rob went to it, I went to it, and I thought it was going to look like it was flat. But about 2 months ago, they had their annual meeting.
Yes, yeah.
And they still say demand is outweighing the supply in Austin area.
Still deliverable lots. They're still so concerned about a developer, delivering buildable lots, a subdivision, basically. There's still a huge concern about that because the big ones that you have out there are almost completely built out. Terra Vista and all these up on the northern part. Really the hotbed, and I think us with this new loan request we got down there in Buchanan, that's going to be the next big growth is right there. They got water down there. They got obviously land down there. That's going to be where, it's where you're going to see these AV ranches are going to be down that way and those things.
Hey, Robert, is there any way to capture what you're doing in that second fund that you had so it's more dividend producing rather than interest producing? The returns, so that they are dividend as being paid as an interest. Interest becomes regular income.
It is. Maybe I'm not following your question.
There's two components when you're taxed. It's interest, and it's usually at regular income.
Right.
And dividend income is limited depending on the amount of money that you make. It could be as little as less than 15% total, that you pay taxes on.
Okay.
So something that is paid out of a mutual fund is generally a dividend,
right,
as opposed to an interest payment.
This is interest. This way it's set up is interest.
And the question is, can it be done in any other way?
No, sir. Not that I'm aware of. No. Yeah, you're an owner, you're a member, you're getting the interest that's generated.
That's because you can't convert the interest you're getting into dividends to pay out to investors.
Exactly. Yeah. You're a little smarter than me. Any more questions? If not, I really appreciate everybody coming, and I appreciate the support as always, and we'll keep trucking along.
All right.
Have a good Thanksgiving. Thank you.